Hi everyone. Thanks for dropping in, and we'll start the webinar in about 30 seconds. We'll just let a few more people join, and we're just waiting for those latecomers. So if you're dialed in already, or you're watching the replay now, then just feel free to hang about for a couple of minutes, and we'll wait for them to come online. So we're just going to give everyone just another couple of another minute or so to drop online. I've just started the webinar a bit early, so we'll just give it another minute or so. All right, everyone. Thanks for joining us tonight. We'll be looking at how to pay down your mortgage over the next sort of 40 minutes to 45 minutes. Before we get started, at any point in the next 10 days, you can re-watch this webinar. I'll send you the link in about an hour or so. And if you'd like a copy of the slides from tonight, you can just email me at events@mortgagelab.co.nz. There's no cost, obviously, for the slides. I'll just fire them straight back to you. Just send us an email and say that you watched the webinar and you would like a copy of these slides. So as an overview of tonight, we're going to look at a couple of things. The 4 different types of mortgage accounts. We're going to look at 2 ways of paying down your mortgage, and for each of those methods, reducing your mortgage, we're going to look at how much you can save, and it's generally in the hundreds of thousands of dollars. We're going to look at break fees and how to avoid them. We're going to look at 3 common mortgage structures. Closer to the end, we're going to look at 5 reasons why you may not want to pay down your mortgage and why that's okay. And finally, we'll have 5 questions to ask yourself before structuring your mortgage. So if you're ready, let's start. So the 4 different types of mortgage accounts. The first type we're going to look at is the most common, a fixed interest rate account. With this account, you're promising to pay a given amount of interest over a given amount of time. In other words, you're promising to borrow, for example, $100,000 at 4.5% over 2 years' time. The bank then takes this promise and goes out to find money that they can borrow for less than that. So they might find some money from investors at 3.5%. They promise to pay it at 3.5% over 2 years, and they lend it to you at 4.5%. This is how most mortgages are compared at barbecues across the country. When you hear the term, what rate, when you hear the question, what rate is your mortgage at, etc. And because of this promise, the bank makes to their investors, this account is the one that attracts the dreaded break fees when you break that interest rate. We're going to talk about how to avoid those fees later. A second most common account is the revolving credit account. You can think of this like any old overdraft that you'd get from the bank. You have a limit, let's say that's $10,000, and you'll have a balance, which is what you owe. So let's say that's that might be $8,000. That means you've got $2,000 available that you can withdraw at any time. You can put as much money in as you like into that account. In other words, you could pay off that $8,000 tomorrow, or you could withdraw that $2,000 in one go. The interest is calculated day by day of what you owe. And at most banks, you can get an EFTPOS card attached to this account so that you can use it for everyday spending. Now, a floating account is very often confused with a revolving credit. You can pay as much as you like into the account. However, the key difference is that the money isn't as easy to spend on a floating account. Usually, you have to apply to get that extra money back out again. This is great if you want to put some extra money onto your mortgage, but if you have to withdraw it, if you're likely to spend it, then this makes it harder for you. There's nothing wrong with admitting you're that type of person who spends money if it's sitting there. The goal is to give you flexibility to pay down your mortgage without tempting you to spend it later. And finally, the fourth most common mortgage account is the offset account. This is quite similar to the revolving credit and floating account, except it is a sum of lots of accounts. So imagine the red or the salmon looking bar is your offset account and you owe $50,000 on it. You've got three other separate accounts which have $15,000 of cash in it, or a total of $45,000 of savings. They'll cancel each other out and you'll only pay interest on the $5,000 that you actually have outstanding. Some people find this account needlessly complicated, whereas some really like to separate their accounts out for different purposes like children's savings, holiday savings, tax. It just comes down to personal preference. One really useful way of using this is if your parents wanted to help you reduce your mortgage, but not actually give you the money. So in this example, you've got the $50,000 offset account and you've got two lots of $15,000. So you've got $30,000 of savings. Now your parents in the yellow also have $15,000. They attach this account to your mortgage and they don't get any interest on that money, but they are also reducing your interest on your mortgage. They haven't given you the money, they've just lent you the use of that money to reduce your mortgage. It's a really good way of parents helping without actually giving money across. So now that we understand the basic accounts, let's look at the two ways to reduce your mortgage. Because revolving credit and floating and offset accounts all can have as much paid into them as they like, these two methods strictly focus on fixed interest accounts. So the first method is a lump sum payment. This is essentially a one-off payment paid directly into your mortgage. The second method is to reducing your mortgage is by increasing your regular payments. So you'll have a minimum payment that is required from the bank each fortnight or month. In this instance, you're confirming to the bank that you want to increase this payment. First of all, let's look at the pros and cons of lump sum payments. Imagine that your mortgage is broken into $2,000 chunks. It doesn't matter how many of these chunks there are, they're just broken down that way. On your first payment, you might pay that first $2,000 off, that top $2,000, and each chunk gets hit by a little bit of interest, shown here by the white boxes. On the second payment, every chunk gets hit again with interest, except for that first chunk, which you've already paid off in the last payment. The third payment is the same. All the chunks get hit except that first and second chunk, which have been paid off. And if we expand this out over 30 years, you can imagine it starts to look a little bit like this. That last chunk has had interest attached to it time and time again over 30 years. It's only a tiny little bit of interest, but when it's added up over and over again, it can add up to quite a large number. In fact, the last $2,000 ends up costing you around $10,000 in interest. So now imagine if right back at the beginning of that mortgage, month 1 or 2, you could find $2,000 from somewhere. That would reduce your mortgage by one payment, which means that last $2,000, the one that costs you an additional $10,000 in interest, never existed, which means you're $10,000 richer. Now, I'm going to leave that slide up there for just a second because it's quite common for new homeowners to go out and buy a new household load of furniture when they buy a house. Now, I'm not saying that you can do without furniture or that your current furniture can survive for 30 years without replacement, but imagine if instead of spending $10,000 on new furniture, you could get a similarly good set for $6,000. You'd save yourself $4,000 and you'd put that straight onto the mortgage. That would essentially save you just under $20,000 in the long run of interest. So $4,000 savings on furniture would save you $20,000 in the long run, and it makes it a good deal for that furniture. So apart from buying budget furniture, what are some ways that you could find a lump sum to put on your mortgage? Well, if you're in the lucky few that receives a bonus from work, you might get one. And as we saw just now, you you can turn a $2,000 bonus check into a $10,000 of additional retirement savings by putting it onto your mortgage. You could trade in your car for a cheaper alternative. So this might mean selling your $20,000 car and buying a $10,000 car. And there's a few caveats here, though. It has to be just as efficient, or preferably more efficient. There's no real sense in buying a cheaper car if your petrol bill goes up by $2,000 a year because it's a thirstier car. Depending on your situation, you could maybe turn your second car you might have into an e-bike. They're fast and almost effortless and very cheap to run. Or if you have quite a distance to travel, maybe a motorbike might be more suitable. You may also realize that you have a basement full of old gear that you no longer use. So maybe you've got 3 surfboards and 4 sets of skis that the kids don't play with anymore. Listing these on Trade Me is a great way to get some cash together that was just otherwise lying around. And if you're having trouble deciding on whether you should keep those surfboards, just in case you take it up again sometime, take this slide down with you when you're sorting through things. So while you're sorting through it, remind yourself that what selling the surfboard will mean and what it will save you in the long run. During our seminars that we run, which are a version of this, but in person, we occasionally just brainstorm some ideas of how we might raise money to pay off your mortgage. We had a great attendee tell us about these websites a couple of seminars ago. So they're a place to register to be a house sitter. So this attendee goes out and lives in people's houses while they're away at no cost. He doesn't earn money from it, but it doesn't cost him money either. And meanwhile, he Airbnbs his place and usually makes a few $100s a week. He then pays his usual payments into his mortgage, but he also pays that extra few $100s into his mortgage with that money. So obviously this requires a certain family arrangement. It might be a little difficult to drag children along from place to place, but if you're in a position that you can move regularly, I'd highly recommend this method. And finally, there is nothing wrong with help from the parents. They may have some spare change lying around. They may have some stuff that in their basement that they can sell on Trade Me. It could be a loan to you at a preferential rate, as in below what the bank are going to charge you. Either way, it's going to save you a lot of money in the long run. The key point to take away from this is the earlier you can make additional payments, the more money you will save, the more interest you save on that last chunk, and the more money you save. Just before we leave the lump sum method of paying, remember that negotiating your purchase price down by $2,000 achieves almost the same thing. So if you are purchasing a property for $500,000 and you think that's a good price, negotiate them down to just $498,000, knocks that $2,000 off and saves you approximately the $10,000 of interest. So negotiation when you're buying can be tough, but keep that picture in mind when you're doing it, and you might find a little more enthusiasm just to push them that last couple of $1,000s. Okay, so if lump sum payments aren't for you, our second method of mortgage reduction is, of course, to increase your regular payments. So how does this look? Well, let's look at an example of a property with $600,000 owing on it. It's a 30-year mortgage, and we've fixed it all at 4.6% for the next 2 years. So the next payment on this will be, the payment on this will be $709 per week. And in the beginning, $530 of that payment will go towards the interest payments, and the rest will be towards the principal, or just reducing your mortgage, in other words. Over 30 years, the total cost of that loan will be $1,106,534. Now, I just want to pause for a second here. I hear a lot that if you pay more regularly, in other words, weekly rather than fortnightly rather than monthly, you save more on interest. So this is based on a theory that you are paying down the principal faster when you pay it weekly than if you waited until the end of the month. It's true to a certain extent, but it's so minuscule over 30 years that it just doesn't seem worth bothering with, in my opinion. So here the loans cost us $1,106,534 with weekly payments. But if we'd paid fortnightly, we would have paid a total of, it's very small on the screen, $1,106,795 if we paid it fortnightly, or $1,107,317 paid monthly. So that's over 30 years. You've saved $800 by paying weekly, not monthly. It's a reasonable amount, it's $800, but my suggestion is that you line up your mortgage payments with your salary payments so that you never miss a mortgage payment. Because if you miss it, the fees for missing a mortgage payment far exceed the benefits of paying weekly rather than monthly. Again, it's just a suggestion, but most people try to line up with their mortgage payments to be a day or two after their salary comes in. Anyway, that's just an aside, but let's look at what happens if we increase the payments by just a little amount. What we see here is that the person has increased their payments by $141 per week, from $709 to $850. There's no change to the interest cost, but the principal or the mortgage reduction cost has almost doubled to $320. Believe it or not, with just a smaller increase, they'll have reduced their mortgage by $153,000 and will be mortgage-free in 21 years rather than 30 years. The one thing to note here is that you have to be careful with this strategy. If you commit to raising your payments from $709 to $850 per week, the banks usually won't let you reduce those payments again until the end of the 2-year period in this instance. So you have to make sure that you can sustain this payment even if something happens to your income. Okay, so what are some ways of increasing your income so that you can afford some extra payments on your mortgage? How could you find that extra $141 per week and add it on? The first thing to realize is there are two things you could change. You could either try to increase your income or reduce your regular expenses. So you might try and change your Sky account to Netflix, and you could save $80 to $100 per month. And remember, if you still need to go and watch the rugby, you can still go down to the pub, buy one beer, and watch the rugby there. You could also negotiate your utilities. My suggestion is that you open the door to those door knockers and see what they have to offer. They're a pain, but they can save you some serious money in the long run, which can lead to even more savings on your mortgage. Don't remove any good expenses though, like KiwiSaver or insurance. KiwiSaver is just another type of investment, and that money is going to has been put to good use. Insurance is there in case something goes wrong and you can no longer work. So reducing it is only putting you at serious risk of not being able to pay your mortgage in the future. Incidentally, we don't sell insurance at the Mortgage Lab, but if you don't have insurance in place and you have a mortgage, I strongly suggest you talk to a professional about it tomorrow. It can seem like money down the drain, but when things go bad, and for a high percentage of people, it will at some point in their lives, insurance is the safety net that means you can keep your house and, of course, your sanity. Another method of increasing your mortgage payments, you could start a new business, as long as it is likely to be profitable in the near future. So you don't want a business that is going to make a loss in the first couple of years. Obviously, the best example of this recently is Uber. Maybe working a few extra evenings or a Saturday earns you, say, $500 after tax. And remember that $141 saved you over $150,000 of interest in the long run. So imagine if you put all that extra Uber money into your mortgage. Next, you could ask your boss for a raise. Now, I usually say this with tongue in cheek because most people don't think this is a possibility. But remember, if you can get even a small amount per week, it adds up to a lot on your mortgage. So go ahead and ask. See if you can get another $141 out of them and kick off 9 years off your mortgage. Finally, just one last tip for reducing your expenses: plan your supermarket shop. Don't go hungry and don't go to the supermarket hungry. And if you can, pre-order. I think Countdown will let you pre-order and pick up so you're never tempted by walking through the aisles. Additionally, set yourself a budget for your weekly spend and stick to it. So we've probably heard of break fees. These relate back to one of the first slides we looked at on fixed interest accounts. With these accounts, you've made a promise to borrow a certain amount of money at a certain rate over a certain amount of time. So, for example, $300,000 at 4.5% over 2 years. If you break that contract, the bank will need to find someone else to lend that money to. They may not find someone immediately, and that will cost them money because they're having to pay their investors. So they charge you a break fee. As we know, there are two different ways of paying back a mortgage more quickly. We've got a lump sum payment, or we've got the increase in regular payments. Some banks allow one method and some banks allow another without incurring a break fee. So at least one bank in New Zealand allows you to pay up to 5% of the mortgage off as a lump sum without penalty. Most of the banks allow you to increase your payments by up to 20%. And the largest break fees come from when interest rates have gone down. So why is this? Well, if you've already locked an interest rate at 4%, let's say, and interest rates go up to 5%, the bank is better off if you break your mortgage. They can now lend that money out at 5%, which is 1% higher than you borrowed it at. So how do these two options look in an example? Well, for the old $600,000 mortgage we were looking at before, you could pay up to 5% or $30,000 off without a break fee. There may be a small admin fee, but the interest savings will be heavily outweigh the small fee. Usually, you can only pay this lump sum once per anniversary of your mortgage. So if you take your mortgage out in June, you've got till next June to pay that. You can do it once in that year. So make sure you don't put the money in too early, or you might have a bit more to put on later. The second method is one we've actually already looked at, increasing your regular payments by 20%. In our example earlier, we increased the payments on the mortgage from $709 per week to $850. So that's roughly a 20% increase. And as you'll remember, that took almost 9 years off the mortgage and saved $153,000 in interest overall. The key takeaway here is if you are paying down your mortgage, if paying down your mortgage is important to you, choose a bank that allows extra payments that suit your income. So if you're a commission-based earner, for instance, and you tend to earn large but irregular lump sums of money, choosing a bank that allows you to put that money on as a lump sum might be a better option. If you're a regular salary earner and are likely to get a pay rise maybe, choose a bank that allows you to increase your regular payments easily. Incidentally, the highest break fee I've ever had for one of my clients was $58,000 as one break fee. That's how much the bank charged the client of mine for breaking a 5-year fixed term after just 1 year. The clients had to come up with that $58,000, but in the end, believe it or not, they were happy because the new rate that they fixed at saved them a total of $85,000 over the next 4 years. So they paid 58 to save 85. It's a large hit for an even bigger gain. So if you're facing a break fee or contemplating it, we've got a great calculator that you can figure out the cost versus the benefit of breaking the rate for you. Again, you can just email me at events@mortgagelab.co.nz. You can get the slides and you can ask us for the calculator. So now we're done with break fees. Let's have a look at some of the most common mortgage structures that we've got. Probably the most common mortgage structure looks a little bit like this. So this person has $600,000 of mortgage. They've decided to split the majority of their mortgage, of their debt, over 2 different fixed rate accounts, and they have a small revolving credit account which they make their payment into. Then the bank automatically takes that payment for each of the 2 fixed accounts. They don't have to worry about transferring those other 2 accounts. The bank will do that for them. The goal here is to get that $10,000 revolving credit down to $0 by the time the first fixed rate account matures. So that first one might be a year from now. The Suffix one might be a year from now. The goal would be to get that $10,000 down to 0 in that time. Quite an important thing to be aware of here is that everyone has different things going on in their life. Some people fixing suffix 1 for 1 year and suffix 2 for 2 years would be their most preferred option. The cost of this would be around, say, $704 per week. But another family might want some confidence that at least some of their mortgage is going to stay the same and not be exposed to rising interest rates. They might choose to break their mortgage into 3 accounts. They would have around a third fixed for 1 year, a third fixed for 2 years, and a third fixed for 5 years. So for this, they'd pay approximately $30 more per week, which is a reasonable amount over a year, but they know that at least a third of their mortgage isn't going to change. So neither of these options is more correct. It's each just has its own benefits to a certain type of person. The key point to take away here is to avoid comparing your mortgage and the interest rates you've got to other people. Choose the structure that is right for you. And if you want to have a discussion about it, all our mortgage advisors have a facility to book a 20-minute phone call with them. Just go to our Contact Us page, choose an advisor you'd like to work with, and book a mortgage minute meeting with them using our online booking system. So we've spent a lot of time talking about how to reduce your mortgage, but I just wanted to touch briefly on some reasons why you might not want to reduce your mortgage. There aren't many, but it's worth considering. If you're living paycheck to paycheck and money is tight, it obviously isn't a good time to increase your regular payments. My suggestion is that you look for ways to increase your income or decrease your expenses before increasing your payments. If you're a salary earner and you're contributing to KiwiSaver, I would suggest looking at this first. There are quite a range of benefits that come with contributing to KiwiSaver, which are a little too in-depth for today, but for 99% of salary earners, KiwiSaver is a good place to put your money, and at least up to the point where your employer is matching your contributions, the money you're putting into KiwiSaver. If you have a business, if you have an investment opportunity or a business opportunity that will earn more than the interest rate you're paying on your mortgage, this might be somewhere to put your money rather than your mortgage. Probably the easy example of this that I can think of is my own business. If I have $5,000 in my account, I could put it onto my mortgage and reduce next year's interest costs by say $250. I could, however, put that $5,000 into marketing in my business, and I might increase my income over the next year by $30,000 or $40,000. So that's $250 savings versus a $30,000 or $40,000 income increase. So as long as I then remember to put that extra income onto my mortgage, then my decision was the right one. And finally, if you've got some life changes coming up, maybe one of you is changing a career or you're expecting a new child, now may not be the time to increase your regular payments to your mortgage. Again, it's not a long list, but there are a few very valid reasons why you might hold off on reducing your mortgage just for a short time. So finally, we're just going to look at 5 questions you might want to ask yourself before altering your mortgage. Firstly, how much are you currently paying and how much could you reasonably pay without undue hardship or stress? This will help you figure out if increasing your regular payments is an option. Now that you know how much you can reasonably pay, are you going to be able to afford them for the entire rest of the fixed term? So if you have if you fixed your interest rate for 3 years, are you going to be able to afford that extra cost for the entire 3 years? And if not, perhaps that revolving credit method that we looked at before with the $10,000 revolving credit is more suitable for you. Speaking of which, if you have money in your revolving credit account, will you be tempted to spend it? Are you the type of person that if you have money available, will you spend it on luxury or unnecessary items? If you are, that's okay, but you may want to choose a floating account rather than a revolving credit account. It's more difficult to get your money back out and requires some thought beforehand. Now, by now, you know the different ways to reduce your mortgage. So does your bank offer the method that suits you and your income? If not, if you're not sure, this will be the type of question you could put to us in one of the Mortgage Minute meetings that you can book. And finally, have you got any spare money that you could use to pay off your mortgage right now? Thinking back to this slide here, do you have $2,000 sitting around somewhere, maybe in your garage, maybe as a bonus coming up, that you could use to pay off your mortgage and save yourself 5 times that amount over the life of your mortgage? Okay, everyone, that's us for today. So thank you for coming along. For more information, you can go to mortgagelab.co.nz and either click on Contact Us to talk directly to your advisor, or click on Get Started and begin a mortgage application online. Thanks, everyone, for coming along. Cheers.